Good day to all of you. I am Muruththettuwe, Department of Economics, Rajarata University of Sri Lanka. Today I am going to discuss about the national income accounting and macroeconomic policies in AAT level 1 stage. So this is very important part in our syllabus, as well as it takes 20% of the weight from our total syllabus. So among other lessons, this is a big lesson, as well as this lesson has the highest weight in the syllabus. So it is very important to understand the basic concepts and the way of calculating national income accounting. Yes. What is macroeconomics? There are two branches, as well as two classifications, microeconomics and macroeconomics. Macroeconomics discusses the total economy as a whole, not the one by one unit or one unit in depth, but the total economy as a whole, total output level in the economy, total employment level, that kind of things are there. So we must have a macroeconomic perspective when we analyze, as well as when we take decisions in the business environment, macro environment, because our output will go to the macro environment in the society. Here you can see the hierarchy as well as flow, macroeconomic objectives, macroeconomic variables, macroeconomic policies, macroeconomic instruments, as well as macroeconomic management. These are very common, as well as these are the key concepts in macroeconomics. Macroeconomic objectives are the objectives of the total economy, as well as the total government. Yes. Macroeconomic objectives are the various objectives to be achieved to aggregate economic activity. That's why I said macroeconomics means total output aggregate economic activities. What are the total or aggregate economic objectives? It may be economic growth. Let's see. These are the macroeconomic objectives. Full employment, employing all the resources in an economy. Then economic stability. Stability means reducing the fluctuation. It means price stability and the balance of payment stability. Price is inside the country, so it's called internal stability. Balance of payment is outside the country, so it's called external stability. These two combinations represent the economic stability of an economy. Equity means reducing the income inequalities in an economy. Economic growth means persistent increase in the real GDP in an economy. Sustainable development means achieving economic development, economic as well as social development, with concerning about the environment. It's called sustainable development. In other words, satisfy needs at present without compromising the ability of future generation. We have to protect the resources for the future generation. It's called sustainable development. Then, how to achieve macroeconomic objectives? To achieve macroeconomic objectives, we have to use policies. What are the policies? Policies means the way we apply to achieve macroeconomic objectives. These are the policies: monetary policy, fiscal policy, supply side policy, income policy, and direct control policy, foreign trade policy. We will discuss one by one. Monetary policy means the policy which is conducted by the central bank. Then fiscal policy is conducted by the government. Why should we use economic policies? To achieve economic objectives as well as reduce or mitigate or control macroeconomic issues. Macroeconomic issues mean if we can't achieve macroeconomic objectives, it is called macroeconomic issues. Macroeconomic objective is full employment. If we can't achieve full employment, the problem is called unemployment. Economic growth is the objective, but economic recession are the problem. Controlling price level in an economy is the controlling inflation, price stability, but if you can't do it, it's called inflation. These are the problems in macroeconomy, so it's called macroeconomic problems. Then we use these macroeconomic policies to achieve macroeconomic objectives, what I explained you earlier. Central bank use their monetary policy, they use their money supply and interest rate to achieve macroeconomic objectives. In fiscal policy, government use their tax policy and the government expenditure to achieve their macroeconomic objectives. As an example, there is an inflation in an economy. Government wants to control the inflation. Then government will increase the taxes. When increase taxes, the purchasing power of the people will be come down because disposable income is calculated by subtracting the tax from the income. So when tax increases, disposable income will decrease. Then consumption will decrease. And the demand will decrease, and ultimately we can achieve price stability. This is called fiscal policy. So for each and everyone, policy can achieve macroeconomic objectives. Supply side policy means increasing the aggregate supply in an economy. When we develop infrastructure, when we cut government taxes on investors, then it leads to have the economy grow as well as the increase the aggregate supply in an economy for supply side policy. Foreign trade policies used to control the foreign trade. It's called foreign trade policy. The direct control policy in microeconomics you use price ceilings, price floors, that kind of thing can be used to achieve macroeconomic objectives. These are the macroeconomic policies. Here you can see monetary policy as well as monetary policy instruments are there. Central bank interest rate, open market operations, that kind of thing. Fiscal policy, government tax policy. Then you can see one of the questions I got this from 2023 July paper. Explain the difference between contraction to fiscal policy and expansion to fiscal. There are two other words, contraction and expansion. What does it mean? Yes. What's mean by contractionary fiscal as well as the expansion? Contractionary fiscal policy is used to control the inflation. When there is inflation in an economy, government can use the fiscal policy to control inflation as well as government wants to stimulate economic activity, increase economic growth and employment. Then government can use expansionary fiscal policy. As an example, when government increase government expenditure, recruit new graduates, then government expense will increase. But full employment level will be. So each and every contraction we want and generally as well as the other policies can be used to achieve macroeconomic objectives. What is the answer for this? These kind of questions may be there. The difference between contraction of fiscal policy and expansion of fiscal policy. Contraction of fiscal policy and expansion of fiscal policy are two contrasting approaches government used to influence economic overall health. That's why I say controlling inflation and stimulating economy. When we use contraction of fiscal policy, then it will use to control inflation. As well as when we use expansion of fiscal policy, government can stimulate the economy. This is the nature of it. Then who are the economic actors in an economy? This is also very important. Who plays the activities or roles in an economy? First one is the household, second business sector, third one government sector, fourth one foreign. Then economic activities of the economy are undertaken by these sectors. If you use these two only together, it is called simple economy. Simple economy. When government come to this model, it is called closed economy. Closed economy. But when we come to four-sector model, it is called open economy. Open economy. Then these are the actors who play or who behave in an economy. Let's see. Here you can see household, business firms, government sector, and foreign. The question in the examination paper in July 2023, identify, action verb is identify, not to describe, three main sectors of an economy that contributes to the economic process. The answer is the main actors of macroeconomy that contributes to the economic process are household, business firms, government sector, and foreign. Here is the question. Here you can see the relationship between these sectors. Here only two sectors. It's called simple economy. Household sector, you can see here. Household sector will provide their factor services to the firms. They supply the land, labor, capital, and ownership to the firms. Then firms will give them the payments for these factors. Rent for land, wages for labor, interest for capital, profit for the entrepreneurs. Then what then private sector do is they use this income to buy goods and services, consumption. Then business firms will provide their goods and these services. This is called circular flow of income. This is also a very important part of the syllabus. Then one by one you can see household. Who are they? They have the factors of production. They are the owners of factors of production, as well as the important thing is they are the consumers in an economy. They want to maximize the utility in an economy by utilizing goods and the services. When government sector comes to the model, then household sector has to pay taxes to the government. This is also important. Who are the business firms? Business firms are the producers. They produce goods and services to the economy, as well as they accrue profits. Government is the welfare. Government always represents welfare. Then government will do some welfare activity. provide national security, define property rights, provide public goods. These are the activities done by the government. The fourth one is the foreign sector. They represent imports and exports in the economy. They are the economic actors in an economy. Next, we will move to another very important part of the syllabus. It's called business circle. Here, you can see there is straight line and the line with fluctuation. This is called business cycle. In horizontal line, you can see the time. In vertical axis, you can see the real gross domestic product. What's business? Business cycle can be used to understand the relationship between short-term and the long-term behavior of the macroeconomy. The fluctuated line represents the short-term behavior of the economy, as well as the potential output line will represent the long-term growth of the economy. What are the stages? What are the important points in business cycle? Peak, trough, recession, and the expansion. Peak, trough, recession, and the expansion. Here, these are the important sectors or important points in the business cycle. Recession, trough, expansion, and peak. What is peak? Peak is the highest point. Trough is the lowest point. The way from peak to trough is recession. Then trough to peak is expansion. The lowest situation here, trough. See, the lowest situation of the actual output below potential output is called trough, and the highest situation of the actual output is the peak. Here, this is trough. This is peak. Highest point is the peak. Lowest point is the trough. The stages which move from through peak to trough is called trough to peak is called expansion. What is recession? The stage which moves from peak to trough is called recession. During this period, existing firms will collapse. We had an experience after 2019. We faced COVID situation as the financial economic crisis in Sri Lanka. That period is called recession. The period is very short. Within a very short period of time, it started to have the recession, but it takes more time to recover. Expansion is the recovery in a stage. The stage moves from through the peak is called trough to peak is called expansion. During this period, new firms will come to the market. Existing firms expand their activity. So now Sri Lanka is going to have this kind of stage. It's called expansion. When it comes to AAT past papers, in July 2023 paper, explain the different phases in the business. So what's the answer for it? Here you can see the same answer I got from the lecture note. Here you have to explain what are the different phrases as peak, drop, precision, and the expansion. Very clearly, you can say. Now, we have the background. Now we know macroeconomic objectives, macroeconomic policies, as well as business cycles, economic sectors in an economy, economic actors in an economy. Now we have the background of national income. Now we are going to discuss the approach of national income. The purpose of doing accounts is to create information to take decisions. When it comes to economy, we calculate the amount of output we created within this year to take decisions, to assess the economic activity, to assess the economic progress in an economy. There are three stages as well as three approaches to calculate national income: product approach, income approach, and expenditure approach. Product means then we will assess the product or service which we produce. Income means when we produce goods and services, we have to pay, we have to hire factors of production, and then they will receive income. Then if we add all income sources together, then it's similar to the output of an economy. As well as the expenditure, it means the expenditure to buy output in an economy, which we created, produce, also similar to the income. So there are three stages, three approaches: production, income, and expenditure. Here you can see. When we come to production approach, when we estimate gross domestic product, domestic means inside the country, in an economy, there are two ways we use to calculate the value of output. First one is the final product approach. Second one is the value addition. What's the difference between final product approach and the value addition approach? Here you can see the example. Here you can see the example as an, if we assume our production is bun or bread. The final output is bun or bread. But in a bakery, it is final output. But in a restaurant or hotel, it is also intermediate good for their service. So it's very difficult to identify the final product. So the way we use to identify the output is value addition. Value addition contribution from this sector. If we assume we are going to make garments or make breads. Breads started from wheat. Wheat means we import wheat from Canada. Then grains. Then wholesale producers. Then retailers. Then it comes to the bakery. Then it will become buns of bread. So there are stages in our product. So we can estimate our contribution by subtracting the output. Resources we got from the outside the business. As an example, if we produce breads, we have to subtract the value of flour because it is the contribution from our bakery. This is the way of finding value add. According to production method, we can see the value added, as well as according to income sources, we can see the value. Here, product sources. Gross value added is estimated using by deducting all the values of input. Output minus input is the value addition. Value addition from the carpenter is called, how to calculate value addition from the carpenter, value of the output minus input. Here you can see there are 10 industrial activity economy. If we add the value addition from these 10 sectors, it is called gross value added. Simply, we can categorize these 10 sectors into 3. First one, agricultural. Second one, industrial sector. Third one, services. Here, agriculture represents agriculture here. Then, construction and other things here. Industrial sector, construction. But all other sectors are service. We can categorize these 10 into agricultural, industrial, and service. In this point of view, we can calculate gross value added by adding value addition from the agricultural sector, value addition from the industrial sector, as well as value addition from the service sector. If it is not given, you can add these 10 together to calculate gross value. When it comes to the past paper, here you can see in 2019 July paper, the students were given the sectors and the value. Then they were asked to calculate gross value added at basic price, gross domestic product. This type of questions may be there. When we discuss the value of output, there are 3 prices: basic price, producer's price, and the purchaser's price. What is basic price? In basic price, no any taxes or subsidies. But when it comes to producer's price, the taxes on products will be added, as well as we have to subtract the subsidies on products. It's called net taxes on the producer. Not only that, after adding these taxes, another taxes will be on consumer when they purchase. Then we have to add net taxes. Net taxes means taxes minus subsidies. Next taxes on consumer, purchaser, as well as the profit margin, as well as the transport cost when it comes to purchases price. Here you can basic price, no any taxes, so producer's price minus net taxes is basic price. You add all 10 sectors in the production sector, it's come to basic price. When you add basic price plus taxes minus subsidies, it means net taxes. Instead of this, instead of taxes minus subsidies, we can say net taxes. Net taxes. Net taxes on product. If we add net taxes on product, we can calculate producer's price. As well as the final purchaser's price, how to calculate? Producer's price plus trade margin, profit margin for the wholesalers and retailers, as well as net taxes on the purchase. Retailers, as well as the transport cost. Then it will become purchaser's price. Yes. Here, gross value added plus gross value added plus net taxes equal to GDP. Instead of all these points, sometimes you are given only the net taxes, not the transport cost and other things, but only the net taxes. When you add net taxes to the gross value added, simply you can calculate the GDP level or total output level in an economy within given period of time. It means inside the country, not total world, inside the country, it is called GDP, gross domestic product in an economy. Is the question here. So gross value added at basic price, normally it comes to basic price. Then you have to calculate gross domestic product at market. Here you can see when you add all 10 sectors together, it comes to gross value added at basic price. How to calculate market price? Basic price plus taxes minus subsidy. This is very easy. Then when we calculate economic values, sometimes you will be asked to find this concept, GDP deflator, GDP per capita, net national income, different calculation in there. GDP deflator means calculating the inflation rate like this. How to calculate current price gross domestic product divided by gross domestic product at a constant price, means when we compare with base price in 2015, then we can understand the inflation rate. Per capita means 1%. Total output divided by median population, then we will have income for 1%. In Sri Lanka, around 300 to 400. Net national income. Net, how to calculate net? Gross value minus depreciation. Fixed capital consumption. This is the way of calculating net national income. You can refer your notes as well as the study guides to have further. Here. Another thing is, you will be asked to write the advantages or uses of national income accounting as well as the weaknesses of national income accounting. Why should we calculate national income account? To assess the beauty of an economy. We can understand the whole picture of the economy. To measure the economic growth, to estimate per capita income, to understand the structure, especially agricultural, industrial, and service sectors' contribution to the economy. As well as we can compare Sri Lanka with other countries in the world. These are the to forecast the future by using data. These are the advantages of national income. But some weaknesses also are there. Every thing. Let's see pros and cons. Then the very important point is the housewives' works are not included in the national income account. The products they produce will be included, but the services, then caring their children and treating their parents, putting babies' clothes, that kind of thing, services are not included in that. But if you hire some, you have servants, the payment for the servants will be added. Okay, another question, problem is productive economic activities taken place within informal economy, not included in the informal sector. Non-consideration of the effect of environmental resource, environmental degradation also there. It is not included in national income. Then not the numbers, but the happiness is very important in the society, but it is not counted in the national income. These kind of weaknesses are there. When we come to 2022 paper, July, you are given the following hypothetical data related to economy. Then you are asked to calculate the gross value added and basic price, gross domestic product and market price, and the gross national income market. Then this is another method we use to calculate national income. Here we use income approach and expenditure approach. Okay, what is income approach? Income approach means the second method. What are the components in income approach? Here, income for the employees. Second one, gross operating surplus. Gross operating surplus. It means have net operating surplus and the depreciation. Gross operating surplus. Third one, mixed income. Like self-employed people's income. Fourth one, other taxes, other net tax. Other taxes. If we add these four together, it is called gross value added. Gross value added at basic price. Okay. According to this example, you can see compensation of employees here 1,000. Gross operating surplus 1,400. Mixed income 1,200. Other taxes, net taxes 750. If you add all these together, it's called net gross value added at basic price. Let's see. Here you gross value added, compensation employees, yes. Gross operating system, yes. Surplus, mixed income and other taxes, the subsidies, net taxes, other taxes. Other means taxes on factors of production. Taxes on factors. Yes. When you calculate gross domestic product market price, you have to add other taxes, other net taxes. Gross value added at basic price, here this much. Then net taxes this much, then you can calculate market price. The difference between market price and the producer's price, adding net taxes and transport profit. Then another concept is there, gross national income. I'll show you how to calculate it later. This is another example. In July 2023, you are to calculate gross value added at basic price. Gross value added. You ask to calculate gross value added. How to calculate? Compensations to the employees, gross operating surplus, mixed income and net other tax. Very easy, we can calculate. Then we will have gross value added at basic price. How to calculate market price? Basic price plus net taxes on production as well as the purchases. It means consumer. Yes. Next, It's also national income, not domestic. I'll show you. Yeah. This is the difference. You are asked to calculate gross domestic as well as national. National as well as disposable. Gross as well as net. How to calculate this? Domestic means total output in an economy within the economic boundary. Domestic. When it comes to gross national, the output of residents, not within the boundary, but they can go beyond the boundary as residents. As an example, some people in Sri Lanka, they have invested their money in share market in London, and they will take dividends. But then they have invested their money in some businesses in foreign countries, then they will receive profits. But they are still residents. They are not in other countries. They live in Sri Lanka. So that kind of things we have to add when we calculate national, not the domestic, but the national. Then how to calculate gross national? Gross national. Gross domestic production plus net primary income from abroad. This is the way. Next one is gross national as well as the disposable income. How to calculate disposable income? When you calculate here gross national income, disposable income. Here there is how to calculate gross national income. Then you have to add net primary income from rest of the world. Primary income. Maybe dividend, maybe salary, maybe profit, that kind of from rest of the world. Then it will become national. And how to calculate gross national income? Gross domestic income plus net primary income from abroad. When we move to previous examples here, gross domestic production 10,900, net foreign primary income 300, then it will become gross national. Here you can see domestic plus foreign net primary income, it will become. This is also important. Another thing is gross national and disposable income. Disposable income means whether we earn or not, we have this income to expend to our expenses. How to calculate it? Here. Gross national income will become disposable income when we add net current transfers or net secondary income. The remittances, then our relatives, and they work in the Middle East, maybe in other countries, but they are not residents, but they send money to Sri Lanka. Then when we add it, it will become disposable income. Gross national income plus disposable net secondary income, it will become disposable income. This is the way of calculating disposable income. This is also very important. So what we discussed today is we discuss the difference between micro and macroeconomic. Then we discuss macroeconomic policies, macroeconomic variables, macroeconomic problems, as well as macroeconomic policies as fiscal and monetary policy. Further, we discuss expansionary fiscal policy and contractionary fiscal policy. Expansionary monetary policy and contractionary fiscal policy we define. Then we move to discuss sectors in an economy, actors in an economy, sectors in an economy, then business cycle, as well as circular flow as the background for the national income. Then we came to calculate national income accounting. We said that there are three approaches, as well as we get the similar result. production approach, income approach, and expenditure approach. In production approach, we calculate as a value addition. As a value addition. Then when we add 10 sectors as well as the agricultural, industrial, and service sector value addition, then it will become total value added at basic price. It is similar to income approach, compensation to the employees, then gross operating surplus, then mixed income, as well as net other taxes. It is similar to that, the results obtained from the production. Then, another very important part is expenditure approach. Then I'll take another slide to explain you expenditure approach. Now I'll move to third approach, expenditure approach. We discussed production approach, income approach, as well as now we will move to expenditure approach. What are the components in expenditure approach? Expenditure approach consists consumption. Consumption is expenditure. Consumption. Who will consume? Private sector consumption and then government sector consumption. Here you can see final consumption expenditure, household consumption expenditure, as well as government consumption. Okay. Then consumption expenditure plus gross domestic capital formation. It means investment. Then investment. Fixed capital formation, change in inventory, change in values, consist gross capital formation. It means construction of new things as well as change in inventories. In inventories also investment, working capital. So when we add these three together, government consumption, private consumption, and the investment, it will become gross domestic expenditure, not the gross domestic production. Why? Because gross domestic production is total production in an economic output value. But sometimes government expenditure will consist imported items. Government do expenses to provide the foods and vegetables to the patients in hospitals, but they provide apples, but apple is not our production. We have to send back when we calculate our own production. As well as we exported our bananas or mangoes or papaya, we have to take them again. Then another adjustment, net export. Net export. Net export means X minus M. We subtract, as an example, we subtract apples and we add papaya export. Then it will become gross domestic production. Gross domestic production. It is the pure output of Sri Lanka. So, output of the economy. Then, how to calculate? Total consumption, government and private, total investment, gross capital formation, plus net export will become gross domestic production, but not at the market price. We do our expenses in not at the basic price, but the market price. So automatically it comes as market price. What are the questions related to past papers? Here you can see January 2023 paper. Here all the components are there: private consumption, government consumption, gross domestic capital formation. Okay, but here you are given not the gross domestic capital formation, but fixed capital formation and stocks separately Can you remember previous slide? Previous slide. Here, gross domestic capital formation consists fixed capital and change in inventory. Here, you are not given the gross domestic capital formation, but the fixed capital and change in inventory separately. Then you have to add together to calculate the gross domestic capital formation. Okay. Then you can calculate the value. Here, private consumption expenditure, government consumption expenditure. Gross domestic fixed capital plus change in inventory in stock, then capital formation. It becomes gross domestic expenditure and market price. Okay. Then how to calculate gross domestic production by using gross domestic expenditure? We have to add exports, subtract import, as well as net export. It is called gross domestic production. This is the third method. So again, I'll give you the brief introduction about the today's session. First of all, we discuss macroeconomic environment as macroeconomic objective, macroeconomic variable, then macroeconomic policies, then business cycle, actors in an economy. Then we move to national income accounting. We discuss production method. We discuss income method. Now we discuss expenditure method, as well as we calculated gross domestic into gross national, domestic and national, national as well as the disposable income in the economy. These are the things we discussed today. Okay. Thank you very much.